Today we are doing a deep dive into the used EV credit, specifically Internal Revenue Code Section 25E. Now, if you're an auto dealer, listen up. This isn't just about selling a car anymore. You're now executing a really complex, real-time financial transaction for the federal government. And trust me, every single detail matters.
Okay, let's not waste any time. Let's get right to the stakes. The Inflation Reduction Act has completely changed the game for your dealership. You've basically become a primary data collection agent for the IRS. And as you can see here, that signed declaration on the seller report, that's not just another piece of paper in the deal jacket. No, it's a legal attestation. And getting it wrong has severe consequences. We're talking potential charges of perjury and even federal tax fraud. So, how do you navigate this minefield? Well, here's our game plan. We've broken this down into 6 critical parts. We'll start with the big picture, the mandate itself. Then we'll decode the specific legal rules, dissect that all-important seller report, talk about the crazy timeline, expose the single biggest tech pitfall, and finally, lay out exactly what you need to do to stay compliant.
All right, first up, the reporting mandate. We're going to unpack how what seems like a simple customer tax credit actually turned into a highly regulated point-of-sale financial transaction, one that puts a massive compliance burden squarely on your shoulders.
Okay, Section 2. Let's get into the nitty-gritty of the requirements of IRC Section 25E itself. These are the absolute, non-negotiable rules that decide if a deal even has a chance of qualifying for this credit. First off, the deal has to be a qualified sale. Now, according to the Code of Federal Regulations, this has 3 key parts. 1, it has to be sold by a dealer. 2, the price cannot go a penny over $25,000. And 3, this has to be the very first time the vehicle has been transferred to a qualified buyer since the law kicked in. The buyer status is just as strict. A qualified buyer has to be a person, an individual, not a business. They have to be buying it for their own use, not to flip it for a profit. They can't be listed as a dependent on someone else's tax return. And, this is a big one, they can't have already claimed this specific credit in the last 3 years.
And here's a really foundational piece of the puzzle. The law is crystal clear that this credit is only for sales made by a licensed dealer. This completely locks out the huge private party used car market. The definition is also very specific about who can grant that license, which is how the IRS keeps track of every single entity involved.
Now let's talk about this price cap, because its simplicity is just brutal. This isn't a suggestion, and there's no wiggle room. It's a hard ceiling. If the final sale price is $25,001, that vehicle is permanently, forever ineligible for the credit. There's absolutely zero tolerance.
So what's the credit actually worth? Well, it's calculated as whichever is less, $4,000 or 30% of the vehicle's sale price. This 2-part cap is designed to make sure the subsidy is targeted. It keeps very low-cost cars from getting over-subsidized while also capping the government's maximum payout for any one sale.
And here's where we hit a major operational landmine, the buyer's income. The law says you, the dealer, have to rely on the buyer's signed statement, their promise that their income is below the limit. You have no way to actually verify this. So what happens if they're wrong? The IRS will aggressively claw back that credit directly from your customer, creating a massive customer relations nightmare for you.
Okay, Section 3. The seller report. This brings us to the absolute heart of the entire system. We're talking about IRS Form 15400. This isn't just a receipt, it's a legally binding document that has to go to both the buyer and the IRS, and it has to be perfect.
Now, this table is fascinating because it maps out exactly where your risks are. Look, your dealership's name and taxpayer ID number? Low risk. You know that stuff. But the buyer's name and TIN? That's critical. One typo can cause huge problems. Same for the VIN and the sale price. But the biggest risk of all, that signed declaration at the bottom. It carries a severe risk profile because that's what directly exposes your people to those federal tax fraud implications.
All right, next up, the 3-day mandate. So it's not enough to get the report perfect. You also have to be incredibly fast. The timeline is, frankly, draconian. And as you're about to see, the rollout of this rule was pretty chaotic.
This timeline really tells a story. You had this retroactive deadline for all of 2023. Then, in early 2024, the IRS's own systems were glitching, so they had to issue an emergency extension. And after all that, we landed where we are now, a permanent, unyielding, and super fast rule.
So this is the number you need to burn into your brain. 3.
You have 3 calendar days. That's the entire window, 72 hours to get a perfect seller report successfully submitted to the IRS. If you miss that deadline, that vehicle's eligibility for the credit is gone, permanently.
Okay, Section 5. We've arrived at what is without a doubt the single most dangerous technical pitfall in this whole process. This is the automated algorithmic trap at the core of the IRS system, a rule that has absolutely zero room for error.
The regulation itself, 26 CFR Section 1.25E1, is painfully explicit. It says the credit will be allowed only on the tax return of the taxpayer listed in your report. This creates an absolute unbreakable link between the data you enter and your buyer's future tax filing.
And this shows you exactly how it all falls apart. Look at the seller report your dealership submitted, John A. Public. Now look at the tax return the buyer filed, John A. Public. The Social Security number is the same, but that one-letter difference in the first name? The IRS's automated system sees a mismatch. The result? The credit is automatically rejected. A tiny clerical error in your F&I office can completely torpedo the credit for your customer.
So after hearing about all these risks, you're probably wondering, what are we supposed to do? Well, that brings us to our final section, your compliance imperatives. What are the concrete steps your dealership needs to take right now?
Here are your 5 non-negotiable takeaways. 1. You need rigorous, multi-level quality checks for every piece of data. 2. Real-time submission has to become part of your daily workflow. 3. Your staff must become experts in using the IRS's online portal. 4. Constantly check that your dealership's license is active and in good standing. And 5. You have to treat that final signature with the legal seriousness it deserves. It is a binding legal promise. Ultimately, successfully dealing with these rules requires a total shift in your mindset. A good enough sales process just won't cut it anymore. In this high-stakes world of IRC Section 25E, the only way to protect your customers, your reputation, and your bottom line is with flawless, audited, and immediate execution. Anything less isn't just a risk, it's a liability.